Welcome, everyone, to the Keystone Mergers and Acquisitions Council winter event. We appreciate you joining us today. As of today, we had over 100 confirmed registrants and RSVPs, so thank you for your support. We're confident you're going to enjoy today's meeting and get a lot out of it. I'm Scott Pinchak, the founder and president of KMAC. Along with myself, we have Steve Girash at McNeese, Wallace & Nurick, Brian Wassel at Trout CPA, and Todd Marsteller at Stellar Partners. We do have a LinkedIn page, and we'd love for you to follow us. And we are also always looking for really good, relevant M&A content as it relates to our region in central Pennsylvania and Baltimore and the Philadelphia regions as well. So if you have any good content, please let me know and reach out to me directly. And please follow us on LinkedIn as well. I'd like to say a quick thank you to our sponsors, McNeese, Wallace & Nurick, our media sponsor, Central Penn Business Journal, Trout CPA, as well as 44 Business Capital. Just a quick update on our upcoming events for 2021. Our spring meeting will be this May, date to be determined at West Shore Country Club. Our golf tournament will be in August of this year. And our fall meeting will be in September, October timeframe at Lancaster Country Club. So as far as the agenda goes today, we've identified and have three tremendous speakers that are going to give you a great update on a lot of different things as it relates to the M&A market in this region. First, we have Andy Greenberg from GF Data, and then we have an M&A Lending update with Scott Stevens from 44 Business Capital, as well as Marty McCormick from FNB Bank. And then we're going to do a live Q&A session and panel discussion after all the presenters are done and completed, and we'll bring that back together and have a good, robust discussion around what was discussed today. So without further ado, I'd like to introduce Andrew Greenberg, CEO of GF Data and Greenberg Variations Capital. With that, Andy, the floor is yours.
Scott, thank you. I'm delighted to be able to join this group. It's been exciting to see KMAC get launched. You guys have such a dynamic deals community in central Pennsylvania. I'm happy to be part of it. So I'm going to start off by providing a view of the very interesting deal environment that we see in early 2021 coming out of the unprecedented tumult of the past year. As Scott said, I'm CEO and founder of GF Data. We're a collector and publisher of information on deals done in the 10 to 250 million value range. We get our information from private equity groups completing these transactions. And then we provide quarterly reports and online analysis. And there'll be information at the end of my presentation if anyone is interested in getting more detail. I also am an M&A practitioner. Before Graham Fraser and I founded GF Data, and since I'm an investment banker in suburban Philadelphia, my firm is Greenberg Variations Capital. We target sellers and buyers in more targeted situations. So I have the luxury of kind of being at the crossroads of data coming in, the deals experience in GVC, and then a lot of conversations with other deal professionals around the country. So I'm going to take about 10 minutes to go through slides from the last GF Data report and use that hopefully to set the table for Marty's and Scott's discussion. So this is the view of the GF Data universe going back to 2003. As I said, we get our data from private equity firms. We have 3,600 deals in our database. These are all multiples of total enterprise value to adjusted EBITDA. That's kind of the coin of the realm in our world. And you can see the steady upward march in valuation multiples over the course of the past decade coming out of the financial crisis, with multiples going from the low sixes to the mid sixes, and then plateauing overall in the 7.1, 7.2 range in the past few years, with obvious differences in deal size, going from smaller to larger. In the past year, there have been 3 quite different quarters. Unfortunately, we don't have our data for the fourth quarter yet. We will in a couple of weeks, but I can tell you directionally where we are. The commentary that I wrote on the last report was, coming out of the third quarter, was called Live Cat Bounce, which is kind of a play on words, but was meant to capture the remarkable resilience and recovery in private company M&A that we saw in the fall quarter. So looking at each of these quarters by turn, the first quarter of 2020 was the last period in an M&A environment that doesn't exist anymore. It was the extended seller's market in terms of valuations, capital availability, and deal terms that had prevailed for most of the past decade. Multiples overall averaged 7.3. The 230 private equity firms and other deal sponsors in our cohort did about 90 deals in that period. The second quarter of 2020, of course, is when the coronavirus hit with full force. We, of course, were aware of it in end of February, March, but deal activity in first quarters tends to be weighted toward the beginning of the period. So the first quarter was pretty undisturbed as a normal quarter. And then in the second quarter, you see the drop off in volume, 34 deals done, about 40% of the prior period and the year ago second quarter. So deal volume dried up. It was characterized by deals that were very far along in their processes and or could be completed with little or no debt, since the debt markets froze. Perhaps this is a surprise, but valuations didn't drop. If you look at the aggregate, 7.4 times EBITDA, but then if you cast your eye at each of the enterprise value tiers, there was very little movement. And we took this to be a case of survivor's bias. The transactions that found the finish line under these extraordinary conditions, going back to last spring, were not a representative set. They were, particularly durable, attractive businesses with investment propositions that that remain strong or even enhanced by the early days of the pandemic. So valuations on this much smaller sample held up. Then in the third quarter, we saw a few things. First, as you can see, there was a decline in valuation overall from 7.4 to 6.7 times, but the sample size picked up. The third quarter is traditionally a fairly light quarter, but we went from 40% of normal deal volume to about 60%. Our best guess is that in measuring a COVID effect, the drop from 7.4 to 6.7 is overstated. That a better measure is kind of a rolling average. So in aggregate, GF Data's view is that the effect of COVID on valuations was 0.3 to 0.4 times EBITDA. Now, obviously, there are widely different experiences by industry, and I'm sure Scott and Marty will have their perspective, and I have mine that I can share later, on what was hot, stayed hot, came into vogue as a result of COVID, and then, of course, businesses that were troubled. But moving on, I want to talk about leverage, and I'll leave this up for a minute. This debt head chart is our high-level view of debt utilization, and we cut debt by a lot of different ways in our analysis. This has always been an important part of what we do, because over GF Data has been around for 14 years, the availability and utilization of leverage has been such a part of the story of equity valuations. So in aggregate for the year, and this is for the year to date, for those first three quarters, average of 3.7 times EBITDA. The gray cube is senior debt, and then the little blue box on top is subordinated debt or mezzanine. So, that's 0.6 tenths of a turn. Again, three very different quarters. The first quarter, typical in aggregate of the market that had prevailed, average debt of 3.9 times, much higher utilization. On larger deals, holding a lot of valuations on those transactions. As I said before, in the second quarter, an immediate contraction in debt availability and usage dropped from 3.9 to 3.3 times in aggregate as valuations on that smaller sample stayed constant. And then in the third quarter, the debt markets perked back up, returning to 3.7 times in average. It isn't in this chart, but I will point out that that little blue cube, the mezzanine piece, assumed much larger prevalence in the market. And be interesting to hear from Marty and Scott Stevens on how they're seeing the composition of debt. I said that I would say a word about the fourth quarter, and I didn't. We're just getting into the data, and volume is through the roof. So significant recovery in completed deals. I'd expect that valuations won't be any lower than the third quarter and probably will bounce back also, and that we'll also see a continued comeback in equity value. So when you crank all of this together, equity and debt and composition of debt, these are the average capital structures in completed transactions over the past 5 years. And with such volatility from period to period, obviously there was a lot of gyration in, let me go back to, forgive me for that. A lot of gyration within the periods. So you have equity levels stay constant and then dropping, debt freezing up in the second period and then coming back. So if you take that 50% equity contribution figure for the year to date and unpack it by period, 49.3% for the first quarter, soaring to 56% equity share required in the second quarter. My point about deals getting done requiring a lot of leverage, and then a return in the third quarter to a more normal 46%. So again, we'll see what happens in the fourth quarter. I want to say a word about what we're seeing in deal pricing, in the spreads on debt. This chart shows spreads on senior debt against LIBOR, and you can see the spreads widening as the base rate, 90-day LIBOR, dropped virtually to zero in the second quarter. In the immediate aftermath of those adjustments, at least in our world, in transaction finance, there was not a corresponding drop-off in overall pricing. because capital was so dear, lenders were able to put that benefit in their pockets. Now, the anecdotal evidence that I hear is, as the market has gotten back on its feet, spreads have compressed a bit, but we had not seen that in our data as of the third quarter. And again, I'll be interested to hear from my panel mates the extent to which they're picking up on that. So I think that's a run through of my slides. Here's some information on GF data before I pass the baton. What we're seeing at GF data, what I'm seeing in my M&A practice in early 2021 is sellers of businesses very much returning to the marketplace based on the conditions in their individual businesses. One interesting trend or question that I wanted to raise is that it's my impression that individual or entrepreneurially owned businesses are coming back sooner than businesses owned by private equity funds or corporations. That the institutional owners have more patience and inclination to print a couple of normalized quarters and see what happens. But again, we'll be interested to hear from the rest of the group on that. So with that, I'm happy to pass the proceedings to my friend Marty McCormick from F&B Mezzanine.
Thanks, Andy. F&B Mezzanine is a subsidiary of First National Bank of Pennsylvania, commonly known as F&B. I'm in the Cleveland office. I primarily participate in the $2 to $5 million EBITDA space, so lower middle market. And I thought I'd just jump into the sort of current state of the mezzanine market as I see it. And keep in mind in that $2 to $5 million EBITDA space, there can be some more variability sort of in those smaller businesses. But COVID obviously slowed the deployment of mezzanine debt in 2020. The opportunities dried up sort of second quarter, as Andy's slide showed. Second quarter started to come back. Third quarter got a little more aggressive in the fourth quarter, trying to close by 12/31. But, overall, I think that, from my perspective and my deal flow was down probably 50% over 2019. Buyers could not sort of find good assets to invest in, or if they were looking at a good asset in January and February, had to take a pause to see what impact COVID was going to have on those businesses. So earnings became uncertain. There wasn't a lot of visibility into earnings, and that led to valuation uncertainty. So if in February you were willing to pay $15 or $20 million for a business, you had to take a pause and see what impact COVID was going to have on that. And that frequently led to lower valuations. And the lower valuations were not attractive to sellers. So if you had a letter of intent in February at $20 million, and your valuation based on your earnings in April or May was down to $15 million, it wasn't that attractive to you, and sellers just decided to hold their business till they return. And mezz debt is usually event driven, and by that it's an acquisition, it's a partner ownership buyout, and it's growth capital. And those things were all down in 2020. So the ability to put money to work was certainly impacted. We've started to see it and should continue to rebound to an extent in 2021. I don't think we're going to be sort of fully on the other side of this COVID or the pandemic until the second half of the year. But, there is a lot of undeployed capital waiting to be invested. People just couldn't put money to work, and a lot of funds need to put money to work. Businesses are stabilizing. and getting back to more normalized earnings, and valuations, consequently are improving. I think the senior banks are becoming more comfortable with company performance. There's been enough runway here for them to see how potential borrowers and their existing borrowers performed during COVID, and sort of there's more visibility into the future. And I really see the second half of 2021 being a strong, sort of a full rebound to more normal levels of M&A and more normal levels of the events that drive the use of mezzanine debt. The competitive market space, certainly pre-COVID, and I think Andy's slides sort of showed some of this. Senior debt was aggressive pre-COVID, and that was squeezing out the need for mezzanine debt. In a later slide, I'll show you, mezz is 10 to 20% of a capital structure. Well, if senior's stretching further than normal on the senior side, it squeezes out the need. There was, over the last few years, huge growth in private debt funds. The unitranche product became very popular. The unitranche lenders are less regulated. They can be more aggressive with leverage metrics. The good thing for me is that in the lower middle market, they tend to prefer businesses sort of greater than 5 of EBITDA, and really closer to 10. They're looking to put more money to work. Limited partners of private equity funds were also competitors in the mezz space. If they're participating in the equity, they'd look at the current return on the mezzanine coupon and say, hey, I'll do a small piece of the equity, but I'd also like a piece of that mezzanine slug that's in there. And that's the same with family offices. The pricing, and we'll talk about it on another slide, is attractive returns to family offices that have a bunch of capital and traditionally invested in equity only, are now sort of reaching into the mezzanine space. Another significant source of competition was the SBIC funds. There's been increased issuance of SBIC licenses. I think in June of 2020, there were over 300. I would imagine that's closer to 325, 350 by now. And with the SBA leverage that allows, it just increased significantly the amount of capital to borrowers. I don't see that slowing down. I'm hearing frequently of friends and colleagues that are, applying for new SBIC licenses. Capital structure trends. I think this dovetails pretty well with Andy's slides. The senior debt tends to be 30 to 40%. They're first lien loans. They're secured. When they were getting aggressive, they were taking more unsecured positions, so airball as we all know it. And the upside there is just getting not only the coupon, but also the ancillary business. Mezzanine debt was, sort of 10 to 20% of the capital structure. It's a second lien. Really, that's unsecured. You don't take a second lien very infrequently thinking that the second lien on what the leftover collateral is going to be helpful to you. Return range in that 11 to 14%. A portion of that may be accrued, and by that I mean pricing could be 11% current pay and 2% accrued. Then the accrued piece gets paid at maturity or when the mezzanine debt gets taken out. The upside for the mezzanine, trying to sort of juice those returns, was equity co-investments. And I have a couple examples of those. But you have to buy that equity. You have to invest right alongside either the common or the preferred equity. It's a hard dollar investment. And then the sort of bottom of the capital stack is the equity. It's 30%, 30 to 50%. Sometimes in preferred equity, which has sort of a guaranteed coupon, not guaranteed, but has a coupon that accrues over the life. But more commonly, it was the common equity, looking for return sort of 20% and greater. The upside is they control the business, they own the business, and they have the highest potential return. Just an example here of two examples. But first one is a deal I worked on in the third quarter. It was a precision machining shop on the East Coast. Very nice precision machining shop, $30 million in revenue, great capacity, great equipment that they had there. And I was working with an independent sponsor on this deal. And you can see, from the capital structure here, this is, what I had presented to my investment committee, $10.5 million of debt, which was 34%. It was 2.1 times EBITDA. The mezz debt was going to be 5.5 million, or 17% of the capital structure, 1.1 times EBITDA. And I'll get back to the seller note in a minute, but this was a little light on equity, and that was what was received in the market. The sponsor was going to put in just over 30%. I was going to invest or purchase 500,000 of the equity to get it, a little north of 32%. And that sort of where I said the deal didn't close, there wasn't a lot of senior debt interest in this transaction. There was an airball piece, and now I'll get to the seller note. Sometimes you see this structure, we call it's structure in a capital structure. The seller was willing to take a $5 million note back and get paid sort of over 5 years, but primarily on the back end of 5 years. Senior banks tend to treat the seller note as debt. So they have to count that in their total leverage calculation. So if it was 3.2 times without the seller note, a senior lender frequently has to look at this as debt. And so the leverage was 4.2 times in their mind. Again, that's probably why they just couldn't generate senior interest in this. Mezzanine treats the seller note more like equity. It's subordinated to the senior, it's subordinated to the junior. You have a lot of control over it. So I treat it as equity and below me. So my total leverage in this transaction, I would look at it as 3.2 times. When the independent sponsor couldn't get the senior debt that they were looking for, they ended up backing away from the transaction. Another example, smaller. This was a nice, niche equipment manufacturer in the Midwest. 14 million of revenues, adjusted EBITDA of $1.5 million. It had a really big spare parts business. The equipment, it was a razor blade business. About 60% of the revenues were spare parts. So, and they were high wear, so they tended to be recurring. You could count on that 60% pretty much every year. Once again, these machines were running less during COVID, so there was a lot of due diligence around what 2021 revenues were going to look like if the machines were being run significantly less in 2020. They might not be replacing those parts as often. But the structure here, a little more mainstream structure. They paid a full valuation. If you look, that 6.73 times on $1.5 million EBITDA number was a full valuation. There's fees in there of probably $500,000. So the purchase price was more around 6.4 times without the fees. But once again, the debt was a little less than 2 times. The mezzanine, The sub-debt piece was a little, 1.3 times for 3.2 times total. I was going to purchase or co-invest with them in 400,000 of the equity. And the sponsor in this one, another independent sponsor, they realized they were paying a full valuation. They didn't push the leverage onto the senior and sub debt here. So they brought a nice equity contribution of, just north of 47%. This deal did close, but back to my competitive slide, a couple of the limited partners said, hey, we will certainly invest in the equity in this deal, but we really like that 12% coupon mezzanine sub-debt. So the independent sponsor, just sort of came to me and said, hey, my limited partners want to do the mezz, so you're out. So, two deals that I showed you that sort of didn't close on my behalf. But this one was, I was competing against the limited partners on this, and, limited partners are kings in these type of deals. So, unfortunately, this closed in the fourth quarter. It was a private equity owned business, so it was very clean, good reporting, good management team. I was disappointed not to be in this one, but, that's the market today. Is there's a lot of people attracted to the coupon of the sub debt. Next slide is just, this is really sort of, the mezzanine world. We're very competitive, but we're also we know a lot of each other, and we're sort of colleagues, competitors, and colleagues. This is what you can sort of expect to see in a mezzanine term sheet. It's a fixed price, 11 to 14%. As I mentioned, it's possible that there'll be an accrued portion of that. So it could be 11% current pay, 2% accrued, also referred to as PIK, which is paid in kind. And that's paid at maturity or when the sub debt gets taken out. The security, we're subordinated to the senior debt. We don't get a penny before the senior debt is satisfied. We tend to have a second lien, but it's unsecured in sort of nomenclature. The maturity tends to be 5 to 6 years. Usually it has to expire because we're subordinated to senior. It has to expire outside of the maturity of sort of the longest term senior debt. Equity participation, once again, it's a co-investment. Very rare to see warrants in a transaction anymore, unless it's super risky. Warrants were very popular, 10 years ago. I've been in this business a while. I think I've put warrants in one term sheet, and that was a turnaround business. So commitment fee tends to be about 2% or 200 basis points of the sub debt amount. That tends to get negotiated these days. It's a point to 2 points. And then prepayment penalties. Used to be 3 in the first year, 2 in the second year, 1 in the third year. Now it's more 2 to 3% in the first year, 2%, 1 to 2% in the second year, and then you're done. It provides a little protection, but not significantly. And I think mezz lenders look at sort of the upfront fee and the prepayment penalty as, I don't want to lose this deal over these two negotiable items. Those are the areas where you can have some more flexibility. So I hope that gives you, an overview, a little look at the current mezzanine market. I look forward to your questions, and I will turn this over to Scott Stevens of 44 Business Capital.
Thank you very much, Marty. Appreciate it. Welcome, everybody. Very exciting presentation so far. I'd like to talk a little bit about Main Street and lower middle market, especially as it relates to SBA loans and some more readily available options out there for buyers of privately owned businesses in that lower middle market and Main Street space. I got started commercial lending about 2005, got into SBA around 2010, and I've been in the world ever since. So hopefully some of this experience and details that we talk about today can help you in the future. Let's get started. So what is Main Street? What's lower middle market? Sure, everyone has a different definition. Based on my experience, Main Street to me typically means transactions equal to or less than about $2 million. Lower middle market makes up the span between $2 to $5 million, and anything above $5 million, I typically perceive as middle market. My world is typically in the Main Street and lower middle market space. Another way you can look at this is what type of buyers are involved in these transaction size. It's interesting, Main Street accounts for about 43% of first-time individuals. A lot of those folks are people that want to leave the corporate world, or they're just bored at their job. Maybe they're a manager, but they really want to take control and own a business. Maybe they don't want to start one. So purchasing a business is always more attractive. And you can also see first-time individuals account for about 28% of larger transactions, those lower middle market, 2 to 5 million. The next group is either current or previous business owners. This is an interesting group. These folks have typically owned a business. They've managed P&Ls. They've managed, staff. They've grown businesses. Maybe they recently sold a business and they want to get back into it, or maybe they just want to change industries. Those account for about 35% of Main Street and about 30% of lower middle market. And the last group of folks that I typically run into out there are existing companies or strategic buyers. These are always fun. Typically, they're a business owner and they want to expand their business in terms of geography, product offering, services, diversity. There's a variety of motivations there. They don't make up that much of the Main Street, about 19%, and lower middle market accounts for about 30%. Of course, these percentages go way higher when you're talking about the true middle market transactions north of $5 million. The other piece on this slide is funding sources. Obviously, you need cash and money to make these transactions work. And there's a variety of different sources that people use to get these transactions funded. They can use their actual cash. They can use retirement, roll over some of that previous 401k plan to help them buy a business. They can tap into equity in their home. They can look at conventional and SBA loans that different lenders offer out there. There's also seller paper or seller financing and private equity for some of those larger transactions. So what does 2021 bring to conventional SBA financing? Well, every bank is continuing to develop their appetite for 2021. Of course, vaccination rollouts and all sorts of other things in the news are tending to influence what those decisions are. But lenders are giving pause in basically 3 key areas: business development, processing of their loans, and funding. So they got to be careful about what they're asking for from the referral sources and existing customers. What flag are they flying? What kind of businesses do they want to actually attract? What kind of loans do they want to attract? So they're looking at enhancing credit guidelines and prerequisites for folks, especially out there in the business development side of things. As far as processing or underwriting, they're slowing down. They're double checking, triple checking, dotting all their I's, crossing all their T's, not only in the approval, but also the closing process. No one wants to make mistakes in a little bit of a sensitive environment. And then ultimately funding. You might have a deal that was approved a couple months ago, but might be in hot water depending on the state that they're in, or a spike in outbreak, who knows? So a lot of lenders are adding force majeure language to their approvals. And a lot of folks out there, a lot of lenders out there are looking at this as an opportunity to expand their business, extend their reach and reputation. They can find deals that maybe a previous lender had and couldn't get to the finish line. They're picking up good deals ignored by competition. And lenders are also looking to, educate their referral networks, educate their centers of influence, give them quick solution-based feedback. Try to kind of be flexible in these times that are a challenge for a lot of folks, especially when it comes to borrowing money. As far as credit standards are concerned, if a seller of a business has a PPP loan, lenders are really looking to have that cleaned up and forgiven or paid off before they're looking at transitioning in ownership. And lenders are also looking for an enhanced level of outside post-closing liquidity, rainy day resources, assets that can be converted to cash in in the event that there's a problem in the future. They want to be able to have a borrower or a set of borrowers that have plenty of resources that can fund that issue. Also, sensitive industries. These are just general groups of businesses out there that have been really hammered by COVID-19. Assisted living facilities, gyms, family entertainment centers, hotels. We see, I've seen the most with hotels and motels. That has really been a tough industry to lend to. But I hope that by the end of this year, that industry comes back swinging. So we'll hopefully see more on that. Banks are also looking at interim financial performance. There's basically 3 buckets out there from a timeline. What was 2019 like? How did you survive 2020? And what's the outlook for 2021? And lenders are looking at specific time frames to try to compare so they can gauge how solvent the business is or resilient to pandemic like COVID-19. Business valuations, which are an integral part of SBA lending, is doing a pretty good job striking a balance. They're not penalizing businesses for being impacted by COVID-19. They're not giving credit for businesses that ended up, benefiting from it unexpectedly. So we're seeing a lot of good feedback from our business valuation partners out there in the field. Top 3 sectors by market sector. So if you look on the left hand of this column, you'll see deal sizes, and the very bottom one, the 5 million to 50 million, pure middle market type of deals. You see the breakdown there. But it's interesting, as you go down in deal size, you start to see industries pop up that are more prevalent in those spaces. Restaurants is really sticks out to me on this slide. 20%, the number one group in businesses or deal sizes less than $500,000 of restaurants. And we all know they took a real big beating in COVID. So hopefully that market sector comes back strong as well. So as it relates to SBA for these Main Street to lower middle market, who and what is eligible? It's always a question. And the answer rarely changes, but it's good to just reinforce. You have to be a for-profit business. You have to do business in the U.S. And your ownership has to be either U.S. citizens and or resident aliens. You have to have skin in the game. You have to have invested equity. You have to fail at credit elsewhere tests, where that's a whole different presentation. But basically, you have to have a demonstrated need for some additional financing or credit enhancement, like an SBA 7A. You have to be an active business. And instead of trying to define what an active business is, it's usually easier to define what a passive business is. These are typically for-profit businesses that are passive. Investment real estate is a great example. A 20-unit apartment building is a real business. It is for-profit, but it is considered passive in the eyes of the SBA. Well, what can you do with SBA funds? Basically, SBA funds can address any life cycle of a small business or middle market business. Real estate purchases, as long as the operating entity owns a majority of the space there, those are eligible. Acquisitions, partner buyouts, general ownership transitions, those are all eligible. Businesses can borrow money to expand their business, launch a new product, open up a new location. And for those businesses that might have some debt that could be consolidated and refinanced to improve cash flow, that is also a very eligible and prevalent transaction in the SBA world. So what are some general parameters? Well, the great thing I always like to tell people is look, there's no loan covenants, there's no balloons, there's no prepayment penalties for merger and acquisition deals. So borrowers have a lot of protection there. A bank can't wake up one day and decide that they want to cleanse their portfolio of a certain type of industry and give all those borrowers in their portfolio a 90-day notice. That can't happen with an SBA loan. As far as guarantees are concerned, personal guarantees are always required for an owner that has 20% ownership or greater. And collateral they hold personally may be required if the transaction is less than fully secured with subject collateral. For ownership transitions, acquisitions, you have to have 100% new ownership. The typical transaction in Main Street and lower middle market is you got a 1 or 2 owner business selling to a 1 or 2 owner buyer. And those buyers have to demonstrate a 10% minimum equity injection. So if you have a $2 million deal, with $500,000 of closing cost and working capital and a line of credit, then that project size is $2.5 million. So 10% would be $250,000. That's the minimum injection. Certain lenders can require 15% or 20% per their policy. It really just depends on who you're talking to. If you're in a buyout scenario, there may not be any cash required. It really depends on the performance of the balance sheet, and that's something that your lender can look at with you. Another detail about the buyouts is that if you have a 3-partner business and one partner is leaving, the remaining 2 partners have to have a consistent and active ownership in that business for the trailing 24 months. You can't have a partner that just bought into the business 6 months ago for 25%. You can't have a 40% owner who lives in Tahiti and doesn't have anything to do with the business. So consistent and active ownership is key for those. And can you use seller debt as equity? Absolutely. This is a rule that was embraced by lenders a few years back and can really help in structuring transactions in the M&A space, especially for those Main Street businesses and lower middle market. Out of that 10%, seller financing can make up half of that required injection, or 5%, but it has to be on full standby for the entire length of the loan. So until the loan's paid off or refinanced into a non-SBA product, the seller can't accept any payments for that financing. So 2021 SBA, that's in the press a lot, and rightfully so. Congress, in their most recent relief bill around small business financing and the SBA and the program that they have the SBA run out, PPP is an acronym you're probably familiar with. But for those traditional loans that are getting financed with an SBA 7(a) guarantee, banks get a bump from a 75% guarantee up to a 90%, very attractive for lenders. Borrowers do not have to pay a guarantee fee, which can save some businesses $20,000 to $100,000, $130,000. And there's 6 months of payment relief. This is a similar but different payment relief option that the SBA offered in 2020. If you are taking a loan between February 1st and the end of the SBA's fiscal, which is September 30th of this year, you're going to get 6 months of payments made by the SBA directly to your lender for 6 months, up to $9,000 a month. Very big relief, especially in that Main Street to lower middle market. I have a multi-disbursement deal going on in Montana right now. We expect to close it in March. Then we're going to have about a 4-month construction phase. They're putting a small addition to the building. So the loan probably won't be made permanent until the end, middle to the end of the third quarter. And those 6 months of payment relief start after that. So in that particular scenario, with these SBA parameters for 2021, a customer won't make any payments on this loan probably until April or May of next year in 2022. So needless to say, they're pretty stoked about that. As far as this second version of PPP, it's not like the first. The first, I think if we had to do it all over again, we probably would have been a little bit more cautious. I think some of these general parameters make a whole lot of sense. There's a $2 million lending limit for PPP, down from $10 million from last year. There is a very much appreciated simplified application. The employee size shrunk from 500 to 300. So more of a focus on small businesses and lower middle market businesses. And you have to demonstrate some pain, right? In 2020, you have to find a quarter where revenues were down by at least 25% or more compared to that same quarter in 2019. So it doesn't say you have to pick quarter 2 or quarter 4. You can pick whatever quarter was most applicable and demonstrate that in comparison to 2019. Well, that's all I have for the lower middle market and Main Street update. Mr. Pinchak, I turn it back over to you, sir.
Thank you so much, Scott. Really appreciate all the content, and also much thanks to Marty and Andy for taking the time, again, to deliver great M&A relevant content for our audience today. We are going to now transition over to live Q&A and panel discussion as a follow-up to the presentation. We look forward to seeing everybody in May at our spring event at West Shore Country Club. And with that, we'll transition right over to the live Q&A. Thank you.